Okay, welcome everyone. We'll start lesson 2. Today lesson will go through LO2. My name is Anjum Satar and my email address anjum@ukversity.co.uk. Today lesson will go through our LO2, which is about applied range of management accounting techniques. So we'll go through microeconomic techniques, what is meant by the cost, different costs and cost analysis, cost volume profit analysis, flex budget, which we discussed in the previous lessons as well, which we can relate, apply absorption and managerial costing and product costing, cost inventory. That's all we'll go through these techniques. That's the indicative content, what we're supposed to be learn. So then, yes, so cost of inventories, benefit of reducing inventories in our organization. Okay, so cost unit help with the purpose of planning, control, and decision making. Business often need to calculate the cost per unit of output. The key question, how is and what exactly we meant the unit of output or the cost unit. So this is mean the different thing to different businesses, but we always look at what the business produce. A car manufacturer will want to determine the cost of each car, probably the different component as well. In a printing firm, the cost unit could be specific customer order. For the paint manufacturing unit could be a liter of paint. An accounting firm will want to know the cost incurred each client. To help this is common to calculate the cost per hours and chart time spent by the staff. A hospital might wish to calculate the cost per patient treated and the cost of the providing the bed for each day and the cost of an operation suite. So that's, we can look around cost per unit. So some businesses use this term cost center. Is the more specific why than the given above. The cost center is in which the manager of the center department or division at the location is responsible for cost but not revenue or investment. So this is usually because the center has no revenue stream, not earning, not selling, not dealing with the sales. So for example, research and development department cost, that will be the research and development cost center we can, because they not generate, so their costs can be beared by other department, those are getting benefit from the research and development department. Okay, the profit center is when the managers of the center department and the division location is responsible cost and revenue but not investment. For example, local supermarket where investment decision made by the main board. The investment center is when the manager of a center, usually division, is responsible for the cost and revenue and the level of investment in the decision. So that's called investment decision. For example, US subsidiary global firm, the CEO would usually have the authority to open new factory, close others, and so on. Okay, cost classification. Cost can be classified, collected into logical group in many ways. So the particular classification selected depends upon the purpose for which resulting in analyzing the data. Financial accounts, cost control, cost accounts, budget decision, cost classification by function, by element. So by function is the cost of sales, distribution, admin. This is cost by function. These are called the functional area departments. Then by element, material, labor. By relation to the cost unit, direct and indirect, and by behavior is a fixed and variable. So classification by function, all the accounting purposes costs are split into categorized. Cost to the sales are known as the production cost. Could include the labor, material, salaries, factory rent. Distribution costs include the distribution cost, sale team, commission, and delivery costs. admin include the office cost, IT cost, HR support, and so on. So note some of these costs, each of the above depreciation. This is measure how an asset is wearing out and being used up. The classification depend upon which asset is being depreciated. For example, cost of the sale, depreciation on the machine in the production line, distribution, depreciation of the delivery van, and admin, depreciation of the computer in account department. So cost classification by element, the simple classification specified the cost according to material include the raw material manufacturing. Yes, goods are resold. Labor cost can be consist of not only the basic pay but overtime, commission, and bonus. And other expenses also as overhead include the electric, depreciation, and rent. Okay, so types of costs. Costs can be material, labor. These are the key element. These are also known as direct cost. All the direct cost is known as a prime cost. So direct and indirect cost is known as overhead. Overhead cost is the indirect cost, normally is known as overheads. Okay, so unit cost card, when you calculate one unit cost, you always look around what is the material cost, what is the labor cost, what are the direct expense. You add them together, that give you the prime cost. If you have a production overhead, add them, that become a production cost. Then you add non-production, though not directly used in the production department, selling, admin, and finance, those called total cost. Okay, the unit cost card is the valuation of different cost element, material, labor, and expense, which make up a unit cost. Production may be arrived at a number of different ways. Batch costing, absorption costing, job costing, marginal costing, and process costing. So these costing methods are covered in the later chapter, which we can later lessons we can say will explain. Okay, relevant cost and irrelevant. Relevant cost is the cost if we are making any decision due to that will be direct consequences of the decision, that will be relevant cost. Avoidable cost is in cost term. Relevant cost avoid the cost that would not incur if the activity is related did not exist. Irrelevant, the cost does not affect the decision made, known as unavoidable cost. So that's, is crucial. We need to know and we should know. Okay, so here we're looking the cost volume analysis. So what we can do quickly, we can watch this little video that will help us to be further look around how the cost, and elements. So you will see here in this little video, we've been given the output, sales, variable cost, and the profit. So when the cost increase, when the production, the cost per unit drops. So let's, we'll look around the break-even analysis because this is part of.
In this business topic video, we're going to take a look at really important part of understanding break-even and incredibly valuable when it comes to working out the break-even output. So it's well worth a bit of time. I buy my hoverboards for £50 each from my supplier, and I sell my hoverboard for £100 each. So the first question for you is, how much profit do I make on each hoverboard? What do you think the answer is? For those of you who say it's £50, that's not right. The answer is, I don't make any profit at all on buying for 50 and selling for 100. I merely contribute. The sale of each hoverboard merely contributes to my fixed costs. Because I've opened a shop, I'll have fixed costs trying to sell these things. So the concept of contribution is this idea that by selling items, I can create some kind of contribution to my fixed costs. And once those fixed costs are covered, are matched, thereafter, each time I sell one of my units, it will contribute directly to profit. And that's the idea of contribution. Once I've sold enough hoverboards to cover my fixed costs in the shop, perhaps my rent, my rates, my insurance, maybe having somebody working in the shop to take the orders. Let's have a look at contribution in a little bit more detail to illustrate how it's calculated. Now, the important point is that once I've covered my fixed costs with my contribution, every additional unit should go straight through to profit. Let's just illustrate that with this simple example. In this case, I've got revenues of £100,000 in my business. My variable costs, for example, maybe the goods that I buy from my suppliers, maybe my raw materials, my variable costs for those revenues are £40,000. Now, if you take revenues and take away variable costs from revenues, you get to what's known as contribution, which is £60,000. So £100,000 less £40,000 creates this contribution of £60,000, which I'm hoping will be enough to cover my fixed costs. Let's take a look. The fixed costs in this situation are £40,000. So I've covered my £40,000 worth of fixed costs with my contribution of 60. That should leave something left. It's called profit. Profit is the difference between contribution less fixed costs. So in that case, my contribution was more than enough to cover my fixed costs. I'm operating at a profit. There's my contribution, £60,000. Now, how do we measure contribution? There are two important measures that you need to be familiar with and need to practice. And in particular, the one on the right, contribution per unit, is incredibly useful if you're asked to calculate what the break-even level is, or the break-even output. Total contribution is calculated by taking total revenues for the business and taking away the total variable costs of the business. So in any business, you can usually split costs into those which are variable and those which are fixed. For contribution, we are only interested to give us contribution per unit. That's a really important.
So, as you will see here, the total contribution is the total revenue, which is the total value of the sale, or we call turnover less total variable cost.
Now, let's just work.
Here is example: £10 is the selling price, £4 is the variable cost, 10 minus 4 is the £6 is the contribution per unit. So fixed cost, which is 10,000 divided by 6, yes.
Of £10 and a variable cost per unit.
So we can find break even. How many units we will be? So you will see 6 is the contribution. So if we are selling 3,000 units, 6, so contribution is. So if you want, now what is the variable cost?
We want contribution to get very high marks.
So fixed cost
divided by contribution.
And divided by contribution.
Was £10 less.
So
£6 per unit.
So output will be
£6 per unit. Fixed cost of 10,000 gives you a break-even output in the month.
So we need.
That's the total variable cost even outputs.
So in this, example, we can look around these, the contribution in our slide as well, which is well back to our actual. I gave you all the formulas here. You will see here the first contribution selling price minus variable cost. Yes. If you want contribution fixed cost divided by contribution per unit, so we'll get the break even point, how many units we'll produce, and sell will be break even. Will cover fixed and variable cost together. If we are selling more than that we have a profit, otherwise we have a loss. So contribution required to be break even, how much contribution required to be break even divided by contribution. So you can look around the contribution required to be break even and divided by contribution per unit. So if we know the required contribution like a £6 and the contribution to sale ratio, which is meant by the selling price divided by contribution, so we can calculate the ratios and we can find how many units we will be make and sell it. The ratio is 40 or whatever. So so these are all the formulas we can. PV ratios also known, sale to contribution ratios as well. Required contribution £6 divided by the selling price per unit, we can get it. And then if you know the fixed cost, if you divide with that ratios, we can calculate total value of the revenues. Like here, we'll go with the total volume of the sale to achieve the target profit, fixed cost plus desired profit or required profit or target profit, so divided by contribution. So 5,400 minus yes, because 3 is a contribution, so 5,400 divided by 3, so 1,800 units will sell, will be break even. 3 over 15 contribution over sale price, so is 20% our contribution ratio, which is mean 0.2. If we know the fixed cost, 5400 divided by 0.2. So if we make the sale of 27,000 worth of, we will be at break even. So sale volume to achieve the required profit or target profit, 5400 is our fixed cost plus required profit 33, and our contribution per unit is 3. So we need to be sell 2900 units to be achieve our profit of 33,000. And margin of safety is how much we have saved. So the budgeted sale minus break even sale, if you're selling 3000, we are 1200 units saved. And it meant by how many percent we have saved? 40% then, because we are selling 40% above than the break even. So these concept we can use. Break even is a point where no profit, so that's the point, is no profit. If we are selling more, then we have a profit. If we are selling less, then we have a loss. Okay, so this is all about the break-even points and the graph which we can use it in our assignment, and we can cross-reference as well. Marginal cost is the cost where all the variable costs count. It helps to make the short-term decision. Like marginal, the cost of every successive unit is a margin. So contribution is the fixed selling price minus variable cost is. So the contribution we calculate under the marginal costing. So marginal costing is the in the closing inventory value is based on the variable cost. Under the absorption costing is both fixed and variable. So normally in the absorption costing method, also known as the full cost, closing inventory value can be higher, so profit can be profit can be lower, so vice versa. So what we need to do, inventory levels will in a period and decrease absorption costing, higher profit, more fixed costs included in the closing inventory, so the cost sold of good decrease, hence the profit will increase. And decrease in the period absorption costing, lower profit, lower fixed cost, overhead included in the closing inventory than the opening inventory, so the cost of the goods sold increase and lower, so on. So that's are the benefit. And so choices, you can argue in the favor of absorption costing, and you can argue in the favor of against the marginal costing, and that's, we can compare and contrast. Limiting factor, anyone from us really won't say you have unlimited want, unlimited resources. We have unlimited want, but we have a limited resources. So what we need to do, we have to be find the various alternative to use these are limited resources effectively to maximize our profit. Anybody any question, guys? Yes. If anybody any question, either you can drop me email if you're listening this recording. Okay, so that's we can. Types of material. Material can be, if it's the inventory, inventory can be raw material, work in progress, and finished good. Yes, if you open the fridge, you have a raw material, which is meat. If you boil it, kept in the fridge, that's work in progress. And if you boil, just warm it, eat it, that's your finished goods. So inventory ordering level, we always inventory level, each we order level, each the store department issue the purchase requisition, and purchase department drop the purchase orders, the copies of accounts, and receiving the department. So receiving inventory, good delivered, delivery note, delivery check to the purchase order, good received note prepared, good received note sent to the accounts and match with the purchase order, invoice check against the purchase order, and good received note and the supplier being paid. So that's the process of inventory. So like earlier, issuing inventory can be, we can look around based on, yes, different method we can use is a LIFO, FIFO method, last in first out, first in first out method, and which we also mentioned in during lesson 1 was as well a bit discussion, because we have indicative contents with overlap. So we can look around inventory. So we have here, if we look in this slide, so we've been given 3 method of inventory evaluation. First is first in first out. First in first out method is mean anything you buy first, it should be issued first. So on the March 1 we have 10 units worth of £100. Then on the 10th March we bought 30 units further, which is cost us 450. So 450 divided by 30 is a £15 each unit cost us. So if we add it 10 plus 30, we have a total 50 units but the cost is £550 for 50 units. Now we are issuing 25 units. So first of all, first in first out method, I'll open the box first. We'll issue the 10 units. Then the 50 units will issue from the second box, which we bought 10th at the second batch. So 15 times 15, so 225 plus 100. So that will give us the total value of issuing up to that date. Then further we purchased and we issued again. So you will see the March 12 issued 10 units and 15 units and total value of issue. Then March 23rd 15 units we issued, but we got that box, second one 15 unit were there, so we issued 15 from there. So we have, then how much was, because we issued inventory 25 and 15 40 units, so we have total 630 plus 20 50 plus 10, total were 60 units. So out of 60 we issued 40 units, so 20 units left. So 20 units left, those left is a loss. Yes, the box, whole box left. So that's, so we have, so if we look, the total value of inventory is 870. And if we add them, 870 minus 325 minus 225, and remaining will be our closing inventory. And then when we do the lost in, so we're going backwards. Yes. So we'll look around before the date of issue, whatever the inventory we have. So first, if we're issuing 25 units, so 25 times will be 50 in this, and there will be, and then second box will go back. So 15 units that will be issued with £16 each, and that will be give the total value of issuing. So total value of issuing, total inventory minus total value of issuing, so remaining will be closing inventory. So that's the way we can calculate. If it's FCO, you can find the average bid cost before the date of issue, and we can calculate. This is also given here as well. If any question, like before the date of issue 12 March, we have 10 and plus 30 and their value. So the total unit was 40. So average unit cost us £13.25 times 25 units. So that's the value of issue. Then we issued again 15 units. But how much was the average inventory that? Yes, average cost. So we found it, that was the £15 each, because what we done, how much was left before and bought new. So total we have the units is, yes, 35. So we divide it, we calculate the average cost, then we issued 15 unit on the average cost, and that cost us, that's the total value of issuing. That was the total value of inventory, 870 and we minus the issuing, and it's become the closing inventory value. So that's the way we can calculate, guys. If anybody any question you not get me, then absorption costing means full cost, and we can prepare the statement. Then ABC is known as activity based costing. As your activities increase, your cost will increase as well. In the activity cost, we always try to find the cost driver, which thing drive that cost. So we need to be make sure, guys, we need to be follow which thing drive the cost, because the cost driver we need to find, and then we need to calculate the cost accordingly. Then we have a job cost. Job cost, like a builders, they have a job, and each job we can compare the separate cost and the benefit analysis we can do. The job costing is the cost unit that consists of the single order of the contract. That is a job. Like builders, yes, extension house, that's a job cost. Okay, batch costing, total batch cost divided by the number of units we produce in the batch. So we can find, what is the per unit batch cost. Service costing, as they like NHS and various service organizations, they provide the service, so we can calculate the cost based on the service. So the total cost for the period divided by the number of service we provided. So then we have a step 1, we can calculate. Then we have a method is called process costing. Process mean we're not making one unit under one factory. Maybe there are the various process and the various steps involved, and we can calculate. So what we need to do, therein can be a normal loss, which we expect. A normal loss is more than our expectation, and abnormal gain, which we was, if we don't have a normal loss, which can be abnormal gain then. So input cost divided by expected output. So we can cost per unit, we can calculate. Like here, if we look there, 1,000 unit we want to make, that should be costed. So if we look, 1,000 minus, so how much we are expecting normal loss is 100 units. So 1,000 minus 100, so we should 45 divided by 900, so it should cost us £5. But actually what's happened, we produce finished good 850. So 850 we produce, actually we should produce 900. So 50 is abnormal loss. So that's abnormal loss we have will be, no, that's the abnormal loss 50. Yes, times 5 pence per unit, £5 per unit, that will be £250 worth of the loss. Okay, if we have any normal loss scrap value, so we can multiply, we can look around. So we have this plus this, that make total 4,500, and abnormal loss account. So we can say the 50 units, 250, and that goes in the profit and loss. Okay, so process accounts, revenue, scrap, if we have a scrap value of that, which we expect like 100 units, and that we can sell it, if we can sell it, like 45 minus 40, we can recover it. So the cost will drop to 4.955. Yes. So if we do on the scrap, because expected output divided by expected cost divided by and minus scrap value and divided by expected output, which was like 900. So now it's 4.955. So that 50 will 200. So we can multiply and we can calculate that through this as well. Okay, so this is, you will see there the inventory, work in progress, cost, material, labor, overheads, unit of output, complete, closing inventory, and we can calculate closing work in progress, how much we have, based on, yes, completed production 30 to 100% complete, material wise, yes, labor wise, so that's 100%. Closing inventory is 800, 100%, and then material wise is 100%, labor wise is 60%. Yes, so we can find the cost and we can allocate the cost accordingly. Yes, guys, that's the way we can prepare the process account. Step 2, prepare the statement cost and cost equivalent. Equivalent is mean how many units we actually and make and sell it, work in progress we have, and that goes in, and the finished goods, and the work in progress, we can calculate the separate cost. Okay, which we'll refer in the next lesson as well. If you have a question, you can ask, please. So what we need to do, copy this link, please. What you need to do, make sure, before next lesson, please play the quiz. So this is the quiz you can do, like here you will, so you can play your end, please. Yes. So you will see here, so you can say resume and you can say break even. So what is a break even? Break even output can be calculated dividing fixed cost by contribution per unit sold. So you can think about, is it right or wrong? Like, so you have to select it and you will see there, is it correct or if not correct, at the end will show you all the answers. Yeah. And you can review it, please. That's all today lesson. So today lesson we discuss about different costing and costing method, analysis, and contribution and limiting factors. So that's all was today lesson, and the next lesson will go through LO3. In between, if you have any question, please drop me email on my email address uk@ukversity.co.uk. Thanks for listening and attending. Hope to speak to you all during next lesson. Bye bye.